Hello, this is my video on my learning summary on the fourth week of Corporate Finance at IPMI International Business School Graduate Program. In this week, we will learn about capital structure and dividend policy. First, about capital structure. Capital structure is the way a company finds the best mix of its debt and equity proportion to finance its asset that will be used for generating revenue. Now, investors usually backing off when faced to a company with a certain level of debt. Sure, we knew that that is risky, but for us as an investor, is it really that bad? Usually using debt up to a certain level actually could increase the firm value for shareholder because it will provide a tax shield since the interest expense is tax-deductible expense, meaning a levered firm pays less taxes than unlevered firm. Hence, as long as interest rates and transactions costs are low, it could be favorable for both the company and the shareholders. That's why for a company with fixed asset intensive, its debt ratio tends to be high because they could use their huge fixed asset as collateral to increase its loan ceiling. So if a company may seems to be quite leveraged, don't instantly judge it as a bad sign. Examine further whether that debt being carried is reasonable enough to maximize the firm value. Second, about the dividend policy. From the investor's point of view, is it better for a company to use its retained earnings to pay us a dividend? Or is it better for the retained earnings itself to be held by the company? It depends on your own preferences on this matter. Basically, if a company chooses to hold its retained earnings, the dividend yield is zero, but the stock price would be increased and we enjoy the capital gain. You may choose this kind of company if you are sensitive towards tax issue, because dividend received will be taxed immediately, while tax on capital gain is basically deferred. Capital gain will only be taxed when your stock being sold and the rate is lower than the tax on dividend. On the other hand, if a company chooses to use its retained earnings to pay dividend to us, we get some cash, but the stock price will be decreased and we might not get a capital gain. You may choose this kind of company if you are okay to be taxed and prefer a current cash payment over a risky expectations on future capital gain. Well, that's it for this week. Thank you.